Okay, let's cut straight to it. Macy's Inc. just dropped a pretty stunning second quarter 2025 performance.
Stunning is right. Significantly beating market expectations.
And maybe even more important, dramatically raising their full year guidance.
Exactly.
So today we're diving deep into these results, looking at the strategies that seem to be paying off and what this resurgence really means for such an iconic retailer.
Yeah, this isn't just, a standard quarterly beat. It feels like a really critical moment for their whole bold new chapter thing.
Right.
We're going to unpack the wins, look at the strategic shifts, and also consider those economic currents, including the tariff talk that just won't go away.
So our mission for you today is to walk away with a clear, well-informed picture of where Macy stands and what might be next.
Let's do it.
All right, let's jump right into those headlines then, because the numbers themselves are pretty compelling. Macy's didn't just meet expectations, they really soared past them. Net sales, adjusted EPS.
Both beat their own guidance, which is key, especially, considering last quarter they actually slashed guidance.
That's a huge turnaround.
It is. And pulling off this kind of performance, achieving their best comparable sales growth in, 12 quarters, that says a lot about their operational execution right now.
It suggests the strategy is clicking.
It suggests that, yeah, for anyone watching, it signals maybe the restructuring, the investments, are finally starting to show real, tangible results.
Okay, let's hit those key metrics specifically.
Go for it.
Net sales came in strong at $4.8 billion. That's better than they projected.
Definitely a beat.
Adjusted diluted EPS hit $0.41, again, well above their guidance.
Substantially above, yeah.
And maybe the number a lot of folks focus on. Comparable sales, up 1.9% on that owned plus licensed plus marketplace basis.
Yeah.
The O plus L plus M number.
Right. And that O plus L plus M metric, just for clarity, includes their own stores, the licensed shops inside, and their digital marketplace sales. It's the whole ecosystem.
And that 1.9% growth there it's crucial, isn't it?
It's absolutely crucial. It shows real customer engagement across the board. It suggests these multi-channel strategies are actually working, driving sales wherever the customer is.
So it's not just, say, online growth masking store decline, or vice versa.
Exactly. It's broader traction. And no surprise the market reacted so strongly. Stocks surged, 20% in early trading?
Yeah, a huge jump. That's a pretty emphatic reaction to beating expectations like this.
It's a clear market signal. They liked what they saw.
Okay, so the numbers are eye-catching. But for you listening, the real question is probably, what's actually driving this? Where's the engine of this renewed momentum? It's clearly not just the big Macy's stores anymore.
And that's the key thing to understand. This isn't some accident. It really feels like validation for that multi-brand, multi-category, omni-channel strategy the CEO, Tony Spring, keeps talking about.
Using all their different brands.
Precisely. Leveraging the distinct strengths of each one, building a more resilient business instead of relying on just one thing. It kind of pushes back on that whole retail apocalypse narrative, doesn't it?
It does. It shows strategic focus can work. So let's break down where these growth engines are really firing.
Okay, because it's insightful how different parts are contributing. It's not just one big wave.
First up, Macy's Reimagined. These are the reimagined 125 locations, right? The ones getting more investment, better staffing, renovations.
That's them. And they're a real success story here.
Comparable sales up 1.4% on an O plus L basis. So outperforming the average Macy's store, what does that tell us?
Well, it tells us that investing in the physical experience still matters. A lot. It's not just about having stores, it's about having better stores people actually want to be in.
Making brick and mortar work.
Exactly. When you invest thoughtfully in that physical touch point, customers respond. It's kind of a blueprint, maybe, for how legacy retailers can make their stores relevant again.
Okay, interesting. Then you shift over to Bloomingdale's. Wow. Fourth straight quarter of growth. Comp sales up 5.7% on that O plus L plus M basis.
Yeah, Bloomingdale's is really on a roll. That luxury segment seems strong, ready to wear, jewelry, fragrance.
And they're doing these special capsules, exclusive partnerships. Mother, Stout, that Accuway collab with Ava Philippe. Building brand heat, as they call it.
Right, and that's key. It's not just selling expensive stuff. It's about curation, exclusivity, creating buzz. Those partnerships aren't random. They drive desire, make the brand feel relevant. It shows real strength in that luxury space.
A different kind of strategy than the main Macy's stores.
Completely. Tailored to that specific customer.
And then there's Bluemercury, the beauty brand, still going strong, 18 consecutive quarters of gains, comp sales up 1.2%.
An incredible streak, driven mostly by dermatological skincare, and bringing in hot brands like Byredo, Victoria Beckham Beauty, Charlotte Tilbury. Smart moves.
So these individual brand successes, Bloomingdale's, Bluemercury, they show the power of having these distinct offerings, right?
Absolutely. Curated assortments, targeting specific customers. It really validates that multi-brand approach.
Hmm.
What's interesting is how it seems to be lifting the main Macy's nameplate, too. Even including the digital side, Macy's had its strongest comp sales in 12 quarters.
So a rising tide effect, maybe?
Something like that. The whole ecosystem seems healthier.
And beyond the brands themselves, a couple of other points. Credit card revenue was up significantly, 22.4% to $153 million. That's quite a jump.
That is a healthy increase. Shows they're leveraging that financial services side effectively, too. It's another profit stream.
Plus, inventory was down slightly year over year, about 0.8%. Always good to see tighter inventory management.
Definitely. Less risk, better cash flow. And the CEO mentioned seeing a resilient consumer still spending on fashion, denim, contemporary apparel, watches.
Interesting detail, that specific spending.
It is. It suggests that despite broader worries, some discretionary spending is holding up. The question is, how long does that last? Is it sustainable into the second half?
Good question. Okay, so while the quarter was definitely positive overall, it wasn't perfect. There were complexities. Overall net sales, when you include those store closures, actually decreased 2.5% to $4.8 billion. But, and this is a critical point, if you exclude the impact of those planned closures from last year, net sales were actually up 0.9%. That distinction matters, doesn't it?
It absolutely matters. It highlights that core challenge for legacy retailers. Balancing restructuring, closing stores with driving growth in the remaining business.
Right, the closures hit the top line number.
Exactly. They cost about $170 million in sales this quarter. But the comparable sales growth in the ongoing stores shows the core business is healthier. It's like planned shrinkage to build stronger foundation.
Okay, that makes sense. Another detail, gross margin rate. It declined 80 basis points to 39.7%. What's behind that dip?
Yeah, on the surface, margin decline isn't great, but this seems strategic. They took proactive markdowns on leftover spring stuff to keep inventory clean.
Clearing out the old.
Right. Plus, some products were bought under those older, higher tariff rates, which also hit the margin. So it points to active inventory management, even if it costs a bit in the short term, better than being stuck with old stock.
So managing inventory well, even if it impacts the margin percent slightly.
That seems to be the trade-off they made. And interestingly, SG&A expenses, the operating costs, they actually decreased, partly because of the closed stores. But that saving was offset by new investments in the ongoing business.
So still investing in growth, even while cutting costs elsewhere.
Shows commitment to the future strategy, yeah.
And on the balance sheet side, they returned $100 million to shareholders.
Always popular.
And did some financing deals that cut long-term debt by about $340 million. Plus, no major debt due until 2030 now. Sounds like smart financial housekeeping.
It does. Strengthening the balance sheet like that, pushing out maturities, it gives them breathing room, flexibility, especially important in an uncertain economy.
Reduces risk.
Definitely. It frees them up to keep investing in that bold new chapter without immediate debt pressure hanging over them. It's a strong signal of stability.
Okay, so that brings us to the future, the guidance. This is where it gets really interesting, right? After this strong Q2, they've raised their outlook for the full year. Both sales and EPS guidance are up.
Yeah, this is significant. It signals real confidence. But, the question always is, how much is based on their own execution versus hoping the economy holds up?
Right, so the new numbers. Full year net sales expected between $21.15 billion and $21.45 billion. Adjusted EPS between $1.70 and $2.05. That's a noticeable bump from before.
It is. It suggests they believe this Q2 momentum isn't just a blip.
There's always a but. They're still assuming the consumer will be more choiceful in the second half of the year, so some caution remains.
Exactly. They're not getting carried away. And here's a big factor, tariffs. The impact of current tariffs is still a major headwind.
And they've actually revised that impact upwards.
They have. This is where external pressures really bite. They now expect tariffs to hit the full-year gross margin by about 40 to 60 basis points. That's up from their earlier estimate of 20 to 40.
Ouch. So a bigger impact than they initially thought.
Yeah, translating to roughly $1.25 to $1.40 hit on annual EPS, mostly in the fourth quarter. And the CFO, Tom Edwards, talked about exploring more price hikes.
Raising prices.
But he stressed it would be as appropriate, not broad-based. They want to stay competitive. So it sounds like very targeted price increases, not across-the-board hikes.
So it's a delicate balancing act, trying to pass on some costs without scaring off those choiceful consumers.
Precisely. It's surgical. They're talking about negotiating with vendors, getting discounts, and then strategically raising prices where they think they can. It's not just one lever.
And they've diversified their sourcing too, right? Less reliance on China for private brands.
Huge point. Private brands sourced from China are down to 27%. Used to be over 50% pre-pandemic. That diversification is crucial for managing tariff risk and gives them more flexibility. Shows real operational agility.
Okay. And looking just at the next quarter, Q3 guidance, net sales between $4.5 billion and $4.6 billion. Adjusted EPS forecast, actually slightly negative, between $80 and $2.15.
Yeah, that Q3 guidance really reflects that lingering caution about the consumer, and probably when they expect those higher tariff costs to really start hitting the bottom line.
So a realistic view, acknowledging the headwinds.
Seems like it. Acknowledging the recent wins, but also the ongoing challenges. It's a reminder that retail requires constant adaptation.
So wrapping this up, what does it all mean for you, our listener? Well, Macy's Q2 definitely showed their bold new chapter plan is starting to deliver some real results. Key brands are performing, sales drivers are kicking in, and the market certainly cheered.
Yeah, the core takeaway here is a company that's adapting, showing maybe surprising resilience. They've had success with focused investments, differentiating their brand, and shoring up their finances.
But the road ahead isn't clear sailing.
Not at all. They still have to navigate this cautious consumer mood and that persistent, even growing impact from tariffs.
It's a fascinating case study, really. A legacy retailer fighting hard to redefine itself.
It really is. And maybe the final thought for you to consider is this. Macy's has clearly shown they can execute internally on their strategy. That seems proven now.
Right.
But how much will the ultimate success of this whole bold new chapter depend on that internal execution versus those broader economic forces, consumer spending, trade policies that are largely outside their control? That's the tension, isn't it?
That tension between internal strategy and external reality.
Exactly. And it's a question echoing across the entire retail world right now.